Welcome back. I'm George Bucur, Managing Director and Co-Head of MarshBerry Specialty Practice. Today, we return with you with Max Saffian from Fortress Investment Group. We've been exploring the debt markets and how they've been transitioning over the course of the last year, and more specifically, how they are impacting insurance distributors when it comes to valuation, M&A activity, and overall capital availability from the debt markets. Today, we're going to continue that conversation with Max, and we welcome you back. I think that makes a great segue into why is insurance different, right? We've heard of other industries that aren't even able to get debt leverage at all. But from your perspective, one, why is insurance different? But also, what's the outlook for the next, quarter or so in regards to the overall industry and from a financial perspective, your view on it?
So I would say, from the standpoint of an industry or a company, you can't help where the risk-free rate is, right? That's out of the industry's hands. So you just sort of have to live with that. I think, the quality of this vertical or segment within the sort of broader lending market, it's clearly outperformed, close to really everything else that we look at. I mean, you think about, higher inflation tends to mean rates go sort of higher inflation generally means pricing goes higher on the underlying premiums. Things like geopolitical risks tend not to have real issues. I mean that's something at the forefront. Even the slowdowns that we're potentially seeing in the economy, we can go back and track organic growth rates for the public names in 2008 and 2009. I think it was Brown and Gallagher were both public at the time, and I think I've seen in MarshBerry work as well is organic growth was down maybe 1%, 2% during the absolute worst of the economy that I think anyone on this podcast has really ever seen. And what that means is that I think, when we internally talk about insurance brokerage, I think we just see this as a much better business to lend to. And I don't think Fortress is any different than anyone else around this as, a place where, you want to put capital. So, I don't have a crystal ball, but, using MarshBerry as a, great resource, but also, being a lender to a number of these same companies that you guys bank and looking at where the public companies have sort of talked about 2023, it feels like organic growth is kind of in this 5, 6, 7% rate, with maybe 2/3 of that coming from rate and 1/3 of that coming from exposures. And when you put that against healthcare or retail or anything tied to commercial real estate or some of these other businesses, that just really shines, and I think will always provide sort of a cornerstone of capital for this industry.
I think you very well articulated the resiliency of the insurance segment and frankly the low beta nature of it, meaning it's not that cyclical when you compare it to that of the economy, which I think is very well articulated. So thank you for that. I want to shift gears a little bit because there's been, I don't know if noise is the right word. Some people label it as a crisis in the banking side of things, given Silicon Valley Bank, Signature Bank, and what we saw with Credit Suisse. But all in all, those are generally, I'd say, catering to more of your probably more regional and or operating type banks within the U.S. We've heard a lot of, again, developments as of late. The Fed coming out and saying they expect a recession in the back half of this year. We had positive developments on the inflationary front, with inflation coming down in March compared to what maybe expectations were. And if you take all this into consideration with the backdrop of the issues on the banks, for example, again, Silicon Valley and Signature, do you expect that to have any meaningful impact in regards to debt availability for the insurance distribution segment?
Yeah. I think the answer is sort of twofold in terms of there's the macro and then sort of the micro, right? I think bank failures, especially on the the size of Silicon Valley Bank, that's never good for an economy. And I think the regional banks deposit rates having to go higher to compensate people for, keeping their money there is clearly not a good. It's clearly not a good omen for lending in general. And some of the commercial real estate issues that we've seen sort of pervade some of these banks also makes it difficult. So I think when you look out over the next 2, 3, 4, 5 years, there will naturally be a constriction in lending, especially from regional banks. I just think there's so much pressure kind of on the liability side that there's no way that isn't going to affect the asset side. How much of that slack gets picked up by the larger banks like JP Morgan, B of A, PNC, that are effectively right. Those deposits aren't going under people's mattresses. They're just moving from smaller regional banks to the larger banks. And I think, those banks will be happy to lend to good businesses and will frankly need to put that money out to good businesses, which leads to sort of the micro, which is, again, in the context of, sort of the broader economy, I think, commercial banks probably look at this the same way lenders like Fortress do, which is like, this is where you want to be lending to, right? Like, I think the overall trend will be sort of constriction in lending markets. However, I think within that, I think, our industry will likely outshine some of the others, one. And then two is, I think, the sort of what they call sort of the shadow lending or direct lending businesses, like a Fortress or a Golub or, any of the other lenders who have, effectively financed these large platforms. I think there's been a lot of capital raised and a lot of focus on this industry. So, while we might see some movement from commercial bank to sort of a direct lender or sort of a non-regulated bank, I think that capital is still there. So, I think it probably is more on the smaller side than on the larger side, but it feels like macro harder, but micro should outshine. So it just sort of depends on the interplay between the two.
Excellent. And I would assume, given the characteristic of insurance and the fact that most of the lending we're getting are from established organizations, not necessarily regional banks, but established firms such as Fortress, that once the overall capital markets start to become, let's say, thaw, if you will, insurance is probably going to be the first area where we experience that. And we would hope that, again, that would correct first in the capital markets perspective at this level.
Yeah, I mean, we've already sort of seen it. I mean, it's the, capital markets are backed up, and, we haven't seen a ton of M&A, but, the truest deal selling 20% of their insurance brokerage to Stone Point, I think that shows kind of that, this business is alive and well. We can look at where the public names trade, and they kind of trade in a 15 to 17 times EBITDA band, which supports leverage in 5, 6, 7 times for sure. And on the sort of the larger buyers, the Acrisures, Hubs, the USIs, they still have pretty easy access to capital markets. And again, I think there is a large bid for those loans at very competitive prices. Again, you can't help the risk-free rate, right? So if those lenders were able to raise debt at L300 versus some of the sort of the middle market platforms that are closer to L5 or 600, that L300 hasn't changed, but that L has gone from 1% to 4.5%. So even USI and Hub are still forced to raise at 7.5 versus 4.
Yes, understand. And to your point, frankly, when it comes to M&A activity, we saw the first quarter of 2023 actually higher than 2022. And largely valuations have held consistent really from 2021 through today. There are messaging from buyers that there might be capital constraints or concerns. And that will, I think, largely play out as we see what happens in the debt markets over the next 6 to 12 months. But it sounds like, generally speaking, we're in a pretty good spot. And once the market starts to thaw, starts to loosen up, insurance is likely to see the benefits of that sooner than most other industries. Max, I want to thank you very much. This is a topic that is very important to not just the buyer community, but also the independent operators in terms of how their impact is being, or how their valuations are being impacted by the debt markets and the overall buyer community. And largely, it sounds like it's still open for business on the M&A front and the debt lending side, which is very, very important. Also, want to thank Max and Fortress for their time. Again, Fortress focusing in the financial services segment has a very good position within insurance distribution, largely 20 million and north when it comes to lending opportunities, and has been a trusted partner of MarshBerry's. So everyone, thank you for your time. Max, thank you for your time, and I wish everyone to be well.
Great. Thanks, George. Thanks for having me.